for the better part of 15 years is waking up, getting some coffee, and trying to figure out what's going on in the world. Again, I do this because I'm trying to get a feeling for what could be impacting the real estate market. I'm not a not a stock guy. I'm not. I don't recommend stocks. I don't own any stocks. I haven't owned stocks since Enron and WorldCom kind of bit me in the butt back in the early 2000s. So what I do, however, is kind of watch the market, and I try to peel back what's going on at the consumer level. And I do that because I see understanding the consumers as being one of the indicators to tell me where people are going to be on the greed versus fear scale, right? And I do that because I'm trying to figure out the psychology, because ultimately one of the largest purchases most people make is their home. And I'm trying to figure out, is it going to be a buyer's market or a seller's market? What's going on? What's the competition going to look like and all of that? So that's really why I do this and why I've started to share kind of my thoughts on what I see every day. So going into today's session, I think a couple of articles caught me by surprise. Or actually, I shouldn't say by surprise, but sort of caught my attention. That's a better way of saying it, because frankly, I expected them to start doing this. First and foremost, you have the talking heads. CNBC being the most prevalent, at least that's the site I go to first. And you have Jim Cramer talking about this is not like 2008. A recession is not the foregone conclusion. I believe he's half right. This is not going to be like 2008. Lending is not going to stop. This is not some kind of artificial asset bubble created and blown up to crazy proportions by by Wall Street, frankly. So yes, he is right in that equation. However, I think he's wrong in trying to say, hey, it's not a recession is not a foregone conclusion. I think if he just looks at the indicators of the stocks that we've been talking about for the last week, I think, again, I think he's right. It's not a 2008 kind of recession. This is definitely more like the 2000 recession. And I think that's where we're at in this. So I kind of agree and disagree with him. It's not going to be like 2008. It's going to be more like 2000s. On that side, one of the things that I got yesterday in a note is I actually think lending is going to get easier and easier. And funny enough, I saw a post yesterday, late yesterday, about FHA getting easier on condominiums. As far as, buying those loans. I guess there were some restrictions in place that made it harder before. So now, that's just one small sign of what I expect to come. The other thing on the financing side is I expect a huge wave of refinancing, right? If rates stay low enough, and I think they're going to go lower, because I think the Fed has to act, it's getting that bad. I think we could have a year of refinancing. And, that will add lubrication to the system. What I'll be watching for there is, are people refining the balance or are in recasting the time, or are they taking money out? I think that will be the thing that we need to find as far as refinancing. So that's the one thing. I think you're going to hear more and more people talk about this is not 2008. This is not 2008. Yes, I agree. It's not 2008. It's an entirely different setup. However, I think a recession, as I've been calling now for a couple of weeks, has already started, and we won't know probably until late this year, and in all honesty, probably until Q1, given how the economists work. Right, they want to look back and kind of flag it after the fact. So that's that effect. I saw an article that basically highlighted in California that we are buying less cars. To the tune of 5.6%, if my memory serves, actually my notes serve. That's a big deal, right? Again, just another sign that the consumer is choosing to sit on their wallet, conserve cash, not add more debt, and to go back to the first point, Jim Cramer, that's a pretty big sign, right? Because I don't know what an average car produces as far as employment, but it's not zero. Right. So if the Californians have bought 5% less cars, that is a sign that, something is going on, in my opinion anyway. And again, he looks at a lot more data. So, you know, he's the stock guy, not me. But I think that's an interesting sign to look at. Other things that caught my attention, obviously General Electric being flagged as a I don't know what I want to call it, a troubled company by the individual who flagged Madoff. So you have to respect this person's call. Um, I need to dig into this a little more to figure out what's going on. But where I wanted to highlight it is you've always heard me talk about you have market risk, sector risk, and individual stock risk. I got to tell you, this is this could be a huge individual stock risk. I don't see if what is I have read thus far is true. It is absolutely an individual stock risk. Gosh, I hope so. I couldn't see GE's finding on by this individual kind of affecting a sector, right, or the overall market. This is really an individual stock risk, and one that is um, all too familiar to me, right? I remember, and I've talked about it in the book, where I got burned by Enron. And I remember I was in Europe and I was like, what can I do? What's the safest thing? I thought telephones at the time. And then what's the best telephone? WorldCom. And sure enough, I got bit by WorldCom after the fact. And I could just imagine if somebody was out there and got burned by got nervous in the market last week, kind of retrenched, but felt they had to stay in the market, and then they bought GE. I mean, that's kind of what I went through, and if that happened to anybody, I'm truly sorry. That's I've lived it. That's not a good feeling, and frankly, why I've never been back in stocks, because there are things that you can't control, and I don't like being at the mercy of a company like that. So that's it. I thought another one was U.S. retail sales rose in July. I thought that was really interesting after a couple of disappointing retail reports. Walmart did come out and have some good numbers today. I think that's interesting. So you have some retailers reporting bad numbers, but you have Walmart reporting good numbers, frankly, good if not great numbers. So again, retail probably be up today. I actually wonder if we're just seeing the trade down economy, right? People probably don't want to talk about it yet because it's early, but maybe consumers are not shopping at the higher end stores already and they're just trading down. I don't know if that's true, but it's certainly possible. And if that's true, that's just another sign that we're in for a rocky road going forward. Cisco Systems reported a disappointing outlook yesterday. Their stock's been hit. They are calling the trade war as a significant indicator. I believe if it hits Cisco, it's going to hit others, right? I could imagine it hurting Intel. It's just anybody that's where a large portion of their revenue is around the world. This could hurt, right? And again, I think if Cisco got hit by this and they can't call the future, I can't imagine why other tech companies would not feel the same thing. So it'll be interesting to watch that. Another one I want to talk about is WeWork. And again, I'm under the impression this is going to be much more like 2000. And in 2000, you had things like pets.com and all these other things get ridiculous valuations and then go nowhere. Where today similarities might be what's called the unicorns in the Silicon Valley, pre-IPO companies getting billion-dollar valuations and then pulling an exit. The other day I thought I read WeWork lost $1 billion last year. It's now $1.9 billion in the last 12 months. That they have to go public, right? Because they're burning cash. And again, I think I'm not making a call on WeWork. That's who knows what will happen. But what I am saying is I think there's a bunch of unicorns out there that have billion-dollar valuations that will never go public, and ultimately some could just disappear. Others will get absorbed for pennies on the dollar, and I think that is coming. Last thing is just one more thing on not being like 2008. I said it earlier, but I want to say it again. I think we're going to see easier financing and cheaper rates, and this could be something that kind of limps through this. But at the end, I think what we're seeing now is I feel confident in saying the seller's market is over in real estate. I think the Bay Area and Silicon Valley prices are in trouble. and we are going to see inventory explode. And the unfortunate thing is we're not going to see this for another 30 to 60 days because that's just how the numbers work. But it could be definitely be time to get greedy. I firmly believe this is the best time to learn your market. You need to learn your market before you invest. And again, I'm talking about your real estate investing market. So you know when something's on sale. That's a big deal for me. And that's what I try to help students do all the time. I think what you'll see below this video, go check out the course, just look at the outline. Because again, I think, a lot of you've been talking about investing. And I think what you need to realize is this could be the time, right? It gets scary, but it's, when competition disappears, it's time to get greedy. And I think we're heading into that. And thank you for that nice comment. I actually enjoy this a lot. So I'm having a great time, and I'm glad you're finding value in these videos. All right, let's see how the day goes. And of course, have a great day. Take care. Thanks. Bye.